Hello, everyone. As Will said, I'm Patrick Johnson. I am the investment consultant with XBA Financial Services, which is a wholly owned subsidiary of the Exchange Bank. I've been with XBA now for a little over 17 years, and at XBA, I help my clients with all aspects of investing and retirement planning. Today, we're going to talk about retirement planning and specifically business retirement plans and how those plans benefit both employees and employers. As I said, discussing the benefits of the small business retirement plans, there are employer benefits or employer or business benefits as well as employee benefits. And in doing so and discussing those benefits, we'll also touch on the different types of plans. But before we do that, I would like to share a general market update with everyone. As you can see, for those of you who have investment accounts, you've probably noticed by your most recent statement, we've gained quite a bit of ground since the lows of the first quarter of 2020. Just looking at the numbers, the S&P is up almost 35% over the trailing 1 year, of which is almost 20% year to date. And the other markets are moving right along and really doing well, all things considered. So if you look at all the sectors, they're all north of 30% with the exception of emerging markets and foreign markets. And some experts and analysts believe that those will bring up their performance in the coming months as well. If we break down top performing sectors, and we look at the top three sectors out of the S&P 500, energy's leading the way, which in turn, energy took a sharp decline in March of 20 at the height or the beginning of the pandemic, around market lows. Real estate, as you all know, is coming in at a close second at almost 30% year to date, and financials, surprisingly, are right there as well. We still believe there's room to grow in the financial sector because of the fact interest rates are extremely low. Therefore, we feel rates have really nowhere left to go but up. And if that's the case, rising rates helps banks earn a better spread and in turn earn a profit. So keep an eye on that. Might be an opportunity to maybe reallocate or change positions and get a little more exposure in the financial sector. But on the reverse side, if you look at the bottom three sectors, even the bottom three sectors have, in my mind, respectable performances year to date. The consumer staples 7% plus, utilities at 9.3, and then consumer discretionary at 11.2. So while most of my clients and most investors with growth funds have achieved a better than 15% year to date or 1 year trailing rate of return, and in some cases a year to date return, most people are happy with a 7, 9, and 11% gain as well. So if we look at kind of where we are moving forward, there are always risks to consider. If we just look at the economic data, you've probably heard and read inflation's on the rise. Some experts believe that this is more of a temporary spike and not a lasting impact. Essentially, when COVID pent-up demand meets limited COVID supplies, we feel like inflation will peak and then maybe begin to work its way back down. We don't feel like, or at least LPL Financial's research analysts believe, this number isn't here to stay, that it's transitionary and hopefully somewhat temporary. And so unemployment's continuing to gain ground. And the GDP has been revised to a number that I cannot recall seeing in my 17-year career, and that is now around 6.5% on an annualized basis based off the U.S. Bureau of Economic Analysis. So those are all good things and good points to keep in mind. And so with that said, we'll kind of jump into the benefits of the business retirement plans. In addition to the employer benefiting from plans, employees benefit from these plans as well. And I know over the last several years, you guys have had multiple advisors speak on this topic. And so hopefully I'm able to provide some additional information maybe that you haven't heard. There's only so many things we can mention that probably, let's just say there's probably going to be some overlap on the information you've previously heard, but hopefully we can give you an angle in there to either encourage you to act or at least consider revising your existing plan or opening a new plan. But some of the benefits of to the employee, obviously the number one is tax savings. Employee contributions can reduce taxable income, and they're easy to make through payroll deductions. And so, in addition, contributions and gains are not taxed until distributed. So contributions grow tax deferred. That's a benefit to the employee in reduced taxable income now. And in my opinion, one of the big ones, interest accrues over time, which allows small regular contributions to grow to significant retirement savings. And one of the big ones is if you change jobs, most of these plans, and we'll talk about the types of plans soon, most of these plans can be merged, rolled over, or changed. So that's an important point to consider. Some of the benefits to the employees. I assume that this message will get across to many small business owners. And so it's important for business owners to realize, in addition to the tax deductions that you receive as an employer opening a new plan, you also receive some tax credits due to the Secure Act, which we'll touch on momentarily. But above all of that, it's providing growth potential to your employees through building a nest egg. And so everyone's a little different in their age, their time horizon, their risk tolerance, their additional plans and which plans they use to complement those plans. But take this slide for example. Whether your time horizon is 10 years, 15 years, or 20 years, the Growth Fund of America is a great mutual fund to own inside tax-deferred or tax-free retirement plans. It's one of the most popular growth funds out there. Am I saying it's appropriate for everyone? No. Someone maybe in the age of pre-retirement years, age 60 plus, you're not going to want to dump your entire retirement savings in a growth fund at the top of this market based off current valuations. However, there is a place for a portion of your assets in this fund. Look at this example. Do we all have 10 years to retirement? No. Some of us have considerably more than that, maybe even 20 years. But a realistic monthly contribution of maybe $250 a month. And I'll touch back on this slide. We can own this in a SEP, a simple, a 401k, and an individual K, and just about any of the other types of plans that we'll touch on. Over the last 10 years, and these are real numbers, $250 per month invested in the Growth Fund of America, systematically monthly, grew to $72,799 an average annual rate of 17% a year. So that's a total investment of $30,000 of your own money, grow into $72,700. It's 17%. Now that's a little misleading because the last year and a half has enhanced that return considerably. But the point is long-term growth potential offered through systematic payroll deductions or systematic contributions. And so whether you own the Growth Fund of America or one of the other 10,000 different funds, one of the benefits to the employees in these plans is tax-deferred growth potential over the long term. Step it up 15 years, just the difference in 5 years, same contribution amount, grew to $145,000. Rate of return is a little less because it's rolling returns, but a $45,000 investment still grew to $145,000. Not a bad return. And then lastly, a 20-year time horizon still generated $243,000 with $60,000 cost basis. So the benefits to the employees is long-term tax-deferred growth potential. Benefits of the retirement plans to the employer. So, this is a slide a lot of employers want to, maybe dive into a little more, learn which plan's best for their structure, whether it's sole proprietor, partnership, LLC, And while I'm not an attorney, I'm not going to be able to sit down and tell you, you need to set up this particular structure. What I can tell you is once you're able to determine the appropriate structure for your business through your team or your attorney, then we can help you find the plan that's best for you based off that structure. But generally speaking, most of these plans work for all those structures. But benefit to the business owner. Contributions are tax deductible to the business, which are huge. In addition to the tax deductions, there are also tax credits through new legislation, which is part of the Secure Act. I have a couple different slides that touches on the specifics regarding the tax credits and the tax deductions, so we'll touch on that in a second. But in addition, the assets grow tax-free or tax-deferred in the plan, depending on which plan we choose. So as the employer, you want to offer the plan for your employees, but you also are going to have a nest egg for yourself inside that plan. And so those are all benefits that will benefit you in planning for retirement. And most of the investment options are flexible. So whether we choose a SEP, a simple, an individual K, we can choose a lineup of funds ranging from the top providers, American Funds, Franklin, Fidelity, Vanguard, to individual stocks and or ETFs, or a combination of all of them. And so for someone who has large contributions that they're making over the long term, ideally that plan should own a little bit of all of those investments. So diversification is important, and tactical asset management is value added to you as an employer when you're choosing the trustee to establish your plan. And then again, I guess this kind of goes without saying, but if you're a local small business and you have a good employee who has the ability to go to work with a competitor, your benefits package might be the difference in retaining that employee. And so I think that's just one of many factors that employers should use as benefits in offering plans and attracting and retaining good employees. And so with that said, the types of plans, obviously, like I said before, I know this group has heard this presentation in a couple of different forums several times over the last several years. But we're going to talk about the SEP IRA because it's an important plan, the simple IRA, the individual K, the Roth IRA, and the traditional IRA. And I'm not going to spend a lot of time on each one, but what I'll tell you is the benefits of each plan, with a goal of hoping to, if this is something you feel like will benefit you or your business, let's sit down and kind of dissect it individually, and then we can kind of tailor a recommendation that might benefit you the most. SEP IRA works well for a one-man band. The employer contributes, not the employee. And so contribution limits, 25% of compensation, annual compensation up to $58,000 max for 2021. And that's reduced to about 20% of compensation if you're a sole proprietor due to the self-employment deduction. If you got questions on that, your accountant can probably answer that a little better than I am able to. The contribution rate must be uniform for all employees, and that's being, if you've got, whether you have a one-man band or you have a small number of employees, you have to have a uniform contribution rate for everyone. But you don't have to contribute every year. If business is good, you can contribute. Business is bad, you can cut back. It just must be uniform for employees. And so 100% vesting schedule immediately, as opposed to a 401k, which have vesting schedules, maybe 20% a year for the first 5 years to reach 100%. And there's some other eligibility requirements. Must be age 21 and worked in 3 of the past 5 years. And so the benefits of the SEP, among other things, the flexibility to contribute when business is strong and cut back when things are tighter. They're easy to establish and maintain with minimal IRS filings and paperwork. And contributions are deductible to the business. And in addition to deducting the contributions, there are also tax startup credits that I'll touch on in a moment. And like I said before, it works well for a one-man band. Simple's a little bit different. The simple, both the employer and the employee contribute, whereas the SEP, just the employer contributes. Obviously, it's a savings incentive match plan for employees, but employees can defer up to $13,500 annually, and if they're over age 50, they can contribute a catch-up to $16,500. And the employer has a couple of options for making matches to the simple. You can contribute 3% of compensation, and you do have the option of lowering that to 1% for 2 of every 5 years. Or you can just do a flat 2% compensation as a non-elective contribution. And so everybody's going to be a little different on how they want to set that up. But I think the main point is find out which plan you feel like might benefit you and your employees the most and get it started. There's nothing to say we can't change it or tweak it later. And so, of course, the eligibility for the simple earned at least $5,000 during any 2 prior years and is expected to earn at least $5,000 in the current year. And so the combined benefits of both SEP and simples, tax deferred growth, and this is important, tax deferred growth means when the employee or IRA owner begins taking withdrawals after age 59 and a half, those withdrawals are taxed as ordinary income. And they do not come back tax-free. We'll talk about another option that will provide tax-free return of payments and balance through a Roth provision momentarily. But the benefits of the SEP and simple as well, investment flexibility. If you've got a half a dozen employees and a couple are right at retirement, a couple are young, a couple of them want to be as aggressive as all get out, you can allocate their asset allocation based off each individual need. So one younger employee that wants to be aggressive may own 2 or 3 growth funds, and that's all they own. An older employee who may be approaching retirement and doesn't want sequence of market risk or sequence of returns to come in, i.e. 2008, first quarter of 2020, they've developed a nice nest egg. Say I've got $500,000 in this simple. This is going to be my primary nest egg in addition to my Social Security. I don't want to lose it to the next market decline. So we can reallocate from the growth funds to maybe the more conservative funds or middle of the road funds. So investment flexibility is important in these plans for different ages, being able to be tactical in reducing exposure. And so we can buy stocks, bonds, mutual funds, and just about any of the major investments in these plans. Secure Act tax credits. So if you're thinking about opening a plan for your business, a business plan for your employees, I would suggest, let's sit down and talk about the specifics to find the best plan that's most appropriate for you and your situation, number of employees, who wants to contribute how much. But regardless, if we do that, and if you establish a new plan, the Secure Act gives you a startup credit of up to $5,000 a year for any small employer that adopts a qualified plan, SEP or simple. So start a new plan, up to a $5,000 tax credit. It's a pretty good incentive to do it. And if you have an existing plan, if you will set up automatic enrollment credits, there is a additional tax credit of $500 per year for new or existing 401k or simple IRA plans that include certain automatic enrollment provisions. So if you're interested in learning more about that, get with me and we can kind of dive into that. And the individual 401k is a little bit different animal. Also known as a solo 401k. This particular plan is designed for owner-only businesses, which you can also do if you have a spouse employed with you at the business. But it allows you to contribute more than the SEP and or the simple. And so there are a couple of things to consider when establishing these plans, but it goes back to flexibility with asset allocation is one of the big advantages. If we give you a comparison, as I just said, the individual K offers more higher contribution limits, and it also offers a plan loan feature. I don't necessarily know if that's a good feature to have. It's not a reason to sell the plan, but if you have an employee that's or you have an individual K and you need money, some 401k plans have a provision where you can't take a loan at all. Others you can. With the individual K, you can. It's probably not going to be your first choice in accessing money that you might need, but it is a feature that might help down the road, especially if it can be paid back. And there's also a Roth deferral option on the individual 401k. And so just to give you kind of a quick comparison, if we're just comparing the SEP, the simple, and the individual K, just based off someone who makes $100,000 of income, it's an owner-only business, corporate entity. With the SEP, the $25,000 is the max we can put back this year. With the simple, $13,500 employee salary deferral, employer up to $3,000 on the match, and so it'll be a total of $16,500 for contribution. But if you look at the individual K, contribution limits are a little bit higher there, and so as an owner-only business, you're making a contribution from your payroll, and you're also making a contribution as the employer. So you're kind of you're able to contribute considerably more. In this case, $44,000. So, it's not right for everyone. Not everyone wants to put that much money back. I have clients that are business owners that tell me, look, my business has been successful for 20, 30 years. I don't want to put money in these plans. I want to put money back in the business. And I would say if it ain't broke, don't try to fix it. But diversification is important, and having all of your assets in one investment or all your eggs in one basket sometimes is not the very best way to go about it. Should you put more money back into the business that's doing well? Sure. But should you diversify and offer some additional plans for asset growth? 100%, at least in my opinion. To that point, a lot of times money you put back in the business isn't always liquid. It isn't always able to be turned right back into cash. What if your business valuation declines instead of increases? What if you need money? You can sell shares in these plans and have money in 5 days. Can you get that turnaround in your business? Maybe you can. And everybody's different, but it's something to consider in the comprehensive big ball of wax, so to say. The Roth IRA, I feel like everyone should own a Roth. I feel like the tax-free growth offered by the Roth IRAs add value, and I feel like that while your contributions are max annual contribution limits are limited to $6,000 a year or $7,000 if you're 50 or older, it's a plan that I feel like adds value with the tax-free growth. So and I have another slide to touch on this, but the SEP, the simple, the individual K grow tax deferred. When we withdraw money from those plans later, at retirement or 59 and a half, we pay ordinary tax as ordinary income. The Roth, we do not do that. It comes back tax-free as long as we abide by a few provisions, and that is a 5-year holding period, among a couple of other provisions. So the Roth is individually owned. It's not tied to the business, but it works well for your employees that would like to supplement what they may have through the other plans. And a lot of these plans are interchangeable or eligible to be owned, or you can own multiple plans. And so everybody needs a Roth. If you make too much money to make a Roth contribution, we can do what's called a backdoor conversion. So to qualify for a Roth, if your modified adjusted gross income is less than $198,000, you can make the max contribution, assuming you're assuming you file married jointly. That's contributions reduced if you make more than $198,000 but less than $208,000. That reduction formula is located on the IRS.gov website. It's a case-by-case basis as far as figuring it, so I won't go into it for time's sake now. And if it's over 208,000, you don't qualify, but we can open a traditional and convert it to a Roth. For someone with a 10, 15-year time horizon or longer, it makes sense to do it because the Roth provides that tax-free growth for the long term. And I don't try to get into predicting what administrations are going to do as far as what the tax rates will be or what the markets will do, but markets will do two things. They'll go up and they go down. The valuations are high. The chances of them going down is probably pretty good. With that said, the income, our federal government is in I would say quite a bit of debt, and there are only a couple of ways they can repay that debt: issue bonds, raise taxes. The current administration's already in talks of raising taxes on the corporate tax rate. Will eventually that trickle down to middle America? More than likely. So my point, if you don't qualify for a Roth contribution, make a traditional, convert it, take it on the chin, pay the taxes now, let it grow for the next 10, 15, 20 years, and you'll have a tax-free nest egg. It doesn't matter what administrations do with the tax rates. It's a great way to plan. And so just to touch on that, on the traditional, there's some misconceptions there. You must have taxable compensation to contribute to an IRA, but if you're a spouse that doesn't work, but one spouse does, you can make a contribution. There's no income limits to be eligible. The income limits come in on being able to deduct that contribution. So if you make above a certain threshold, you can't deduct any of the contribution, but you can still make it. And it also depends on if you're covered by a plan at work or not, or if one spouse is covered or both spouses are covered. So, what I'll tell you is if both spouses are covered by a 401k or a plan at work, you really can't deduct any of the contribution if you make over 125,000 combined. And so if you fall somewhere in the middle and only one is covered, you can make a partial deduction. It's between 198 and 208. So, we can kind of work those out on an individual case-by-case basis. This is a biggie, though. As far as tax treatment, obviously, tax-free is better than tax-deferred. And so just remember, the Roth grows tax-free. The traditionals, the SEPs, the simples grow tax-deferred. And it's another big question I get from my clients. They get a little confused on tax-deferred meaning and tax-free. So tax-deferred just simply means you pay no taxes while it's in the plan. When we draw it from the plan, pay taxes as ordinary income. The assets that grow tax-free, no income taxes are owed on the distributions as long as the assets are held inside the Roth for a minimum of 5 years. And again, 401ks, individual case, 403b, SEPs, simples, traditionals, and profit sharings are tax-deferred plans. And your Roth IRAs and the Roth provisions that can be added to a 401k, an individual K, or a 403b can grow tax-free. And the key is finding which plan's right for you and your company. And that's going to take setting down, creating a profile, talking it out, and deciding which option's best. How are we doing on time? Yeah, okay. So in discussing the retirement plans, so I think it's important to discuss the risk associated with retirement plans. Longevity risk being a big one. And then, of course, the market risk or the sequence of returns. And then the other risk we have to consider, taxes and inflation, which we can combat with those plans I just mentioned. And then I think the big one, when you talk about retirement plan, most people are not going to talk about long-term care insurance, but I feel strongly about this. If you have a business that you've worked hard to build and you have heirs that you would like to one day see inherit that business, I think it's very important for you to consider some type of long-term care policy to hedge against the rising cost of health care. And the big one today is we can show you how to buy a plan. If you don't use it, you don't lose it. You can compare it versus self-insuring. And so got a couple more slides on that as well. So just to give you a basic rundown, according to the Department of Health and Human Services, someone turning age 65 today has almost a 70% chance of needing some type of long-term care services and supports. And chances are 1 in 6 of them will develop a disability that requires at least $100,000 out of pocket, which is considerable. So we ran these numbers through Genworth Financial, cost of care in 2020. In Alabama, you're looking at roughly $3,150 a month for assisted living facility. Private room in nursing homes, almost $7,000 a month, which is $80 plus $4,000 a year. Even if you stay there a couple years, you've depleted your estate a little bit, or at least taken away money that could have went to kids, grandkids, or other heirs. So what are some of the solutions to those risks? On the longevity risk, I try to help my clients. Look, if we have a business retirement plan and we're gaining growth in one of those growth funds I mentioned, or any of the other 10,000 different investment options, as we approach retirement, it's not a bad idea to consider taking some of those assets out of the more aggressive investments and maybe rolling them down to something that provides a guaranteed lifetime income stream. Not all of the monies, but a portion of the monies. And so the guaranteed lifetime withdrawal benefit, the guaranteed minimum withdrawal benefit, and other guaranteed withdrawal benefits will allow you to hedge against longevity risk. In other words, you can't outlive your money. The market risk that I think I've spoken on 3 or 4 times in the last how many ever minutes I've been standing here. Regardless of the plan, consider diversifying your money, your assets, as you approach retirement, as your timeline shrinks. Because, if for example, 2007, 2008, not many people saw that coming. If the market sold off 30%, well, for someone who's planning to retire, they just got a 30% haircut. How long will it take them to get that 30% back? And oh, by the way, if the market goes back up 30%, they're still not at par. They're going to need to make somewhere around, without doing the math, 40, 45. And so keep in mind, minimizing risk as you approach retirement will kind of mitigate some of the market risk. That doesn't mean take all your assets out of the market. It just means reposition accordingly. Taxes, inflation, we mentioned it earlier. At some point, our tax rates will increase. And when we withdraw money from these plans, we will owe taxes on the money, assuming it's not in a Roth. And then this is the big one for me. Just like stocks, bonds, SEPs, simples, brokerage accounts, real estate, and all of those other asset classes and investments go into a retirement plan for a small business owner, think about the new single premium long-term care policies, because they protect your business, they protect your estate, and they protect your heirs. And if you don't believe me, just look at a case where someone goes in a nursing home and they spend $85,000 a year for 3 years. It's $250,000 that they've spent of their estate. Why not take $100,000 of that $250,000 you earmark, buy a single premium long-term care policy? Maybe that $150,000 bought you $300,000, $400,000, $500,000 worth of care, depending on how long it is before you need it. And oh, by the way, if you die suddenly, don't need the care, your beneficiaries are going to get at least your premium of $100,000. And I know not everyone has $100,000 laying around, but if you don't, whatever you put in the plan, if you don't use it, you don't lose it. Okay, that's huge, or at least in my opinion, it is. I try to urge my clients to consider it. For example, and we won't go into, because this is not appropriate for everyone, we won't go into a lot of detail, but I just want to give you a reference to what I just mentioned. A 60-year-old female has a successful business, got a little money saved, maybe inherited some money from their parents. Not everybody has $100,000 sitting on the sideline, I know. Have a couple children you want to protect. At age 60, you put $100,000 in the Pac Life single premium long-term care policy. In 5 years, that $100,000 is worth a total of $229,000 for long-term care. So it just turns your 100 into 229 in a matter of 5 years, guaranteed. Day one, your 100 is automatically 188. So I don't have any investments out there that I can guarantee you I can make your 100 grow to 188 in a matter of time to sign the contract and get it in. And so with that said, the longer you need, the longer the time period elapsed before you need care, the higher the greater the benefit. So in 20 years, when you're about 80, when you possibly might need it, that benefit's $477,000, which is $4,800 a month for 7 years. And so if you activate the claim, you start drawing down the benefit, it will reduce your return of premium or your death benefit. But the biggie is, what if you change your mind? What if you get diagnosed with a terminal illness, or things have changed and you just want your money, you want to walk away? You can always walk away with your premium. And so, as you can tell, I feel pretty strongly about planning for long-term care. So keep it in mind. The males are a little different. They feel like we're going to die faster than women, so the benefits are a little better on the front end for males. That same $100,000 premium for a 60-year-old male generated $289,000 in long-term care benefit day one, or $100,000 more. And that is, as I stated, more than likely they feel like we'll pass sooner, and more than likely won't get in the insurance company's pocket. But you never know. And so I'll leave you with this, and that is, not all advisors are jack of all trades. My dad once told me, son, if you try to be a jack of all trades, you'll be a master of none. And so if you own a business, consider surrounding yourself with a good accountant, a good attorney, and a good advisor. Meaning, make sure your attorney helps you with your succession plan. You have a business and you become disabled or you pass tomorrow. Are things going to pass according to your wishes? A good attorney is worth their weight in gold in helping you get that proper structure. Are you in a proper structure now? Partnership, LLC, sole proprietor, whatever it is. And I'm not versed to talk about that, but a good attorney is. So my advice, get a good attorney, get a good accountant who's familiar with your business, look at the books, can tell you what is a feasible number for you to contribute for your employees and or for yourself. And then from there, we can back into it, give you the best plan or a couple of plan options that might work or add the most value, and then also help you look at adding some of that insurance that I just mentioned to the plan. And so kind of a comprehensive approach. I feel like those are important points to consider. And that's really all I have today. I thank y'all for having me. I appreciate your time. I hope some of this was beneficial. And if you have any questions about any of the information that I've shared, you can call me or you can email me, and we can kind of talk about it in detail. Love the opportunity to sit down with you individually, review your profile, and see where we might be able to add value and help you. And thank you.